This is our Forex blog for December 8th, 2011. And like we do each day, we want to sell the absolute weakest currencies versus the strong. Our odds go up when the daily real-time strength matches the daily trend, which matches the weekly trend. And I don't personally care if the monthly trend's up or down, but I do like it to match. It always increases your odds when all the time frames match. And basically what you're looking for is a bout of extreme weakness or strength, followed by a counter trend move of half or even one-third less momentum. And if the big explosive move is in the direction of the daily and the weekly trend, then it's very likely to continue. As you can see here, from 3 to 3:30, it wasn't really that weak, and then it came back and got weak again here. And here's the first sign of some strength coming in, so it's less likely to be weak in the future after momentum move at and above the 80 level. But when you find a weak currency like that, you want to trade it against one of the strong ones. The Australian is strong. The weekly monthly trend's up. Daily trend shifts up at 2. The New Zealand as well. So and the CAD as well, but it doesn't really have real-time strength until about 2 right here. Oops, hold on a second. This is scroll back from yesterday. Let's scroll forward to today. Yeah, so you can see that this one really was weak, and it didn't have the pattern that you're looking for. Extreme weakness followed by a little bit of strength. The weakness is likely to come back. It never had the extreme strength which matched the weekly trend like the Australian and New Zealand did. So basically, you want to look to buy the Australian dollar and New Zealand dollar. And this also gives you a nice, beautiful narrow range pattern. So I will do a narrow range breakout class today because this is a perfect example. And when it breaks out, it goes up about 15 pips. You would have probably got out of this trade. As you can see, it went up with a lot of momentum followed by very little strength. You tighten your stop underneath the sideways range, you get stopped out, comes back down and can't break the hourly moving average, which is frequently a support level. And when it breaks out again, you go long, and you would have probably broke even or had a small win on that. And it comes down again, and usually when the support area gets hit 3 times, it breaks through. When it doesn't, it almost always goes the other way. And so this is exactly what happened this time. It broke out, you go long again, and you can see it shot up about 100 pips. And even if you didn't get in early, when it comes up to the previous day's high, major resistance here and breaks out, a good place to get in, and it shoots up about 75 pips. But the currency meter had you focusing on the Australian dollar pretty much most of the day. You can see the Australian was consistently strong against all the currencies. And you could have also traded the Australian against the euro, which is really weak against all time frames. Perfect pattern here. Extreme weakness followed by very little strength. Let's bring up a chart just to look at the Australian or Euro Australian. I don't look at this one, so I don't leave it running. Weak Euro, strong Australian. This is very likely to go down. And initially today, it doesn't have minus 80 weakness, but it's coming down. It goes sideways here. There's basically 2 methods that we have for getting into our trades. Sideways rectangle patterns like this, and that led to about a 50 pip move down, and then a counter trend trade, which typically I don't like to short currencies that explode up like that, but basically you draw your trend line underneath the bars low. When it breaks, you go short with the only secret of trading, other than our tools, which most other traders don't have access to, is small losses, big wins. And so when you're risking a tiny amount like that, in this case, you made about 60, 70 pips. Beautiful trade there. Again, strong currency versus the weak, and that increases your odds. The yen was quite strong today. The weekly trend was down, but it shifted back up around 4. So you could have traded the yen against some of the weaker pairs. The euro was consistently weak, so selling the euro yen made a lot of sense today. Let's move this range bar chart out of the way here, and you can see that's exactly what happened. This currency was going sideways here. We have 2 narrow range patterns in a row. Typically, breakouts of those lead to big trends, and when the breakouts fail, usually, like I said in another class earlier this week, you get explosive moves the other way. So this was a very high probability short. You have a counter trend trade here that led to about, only about 10, 15 pips. You have a counter trend trade here that you probably got stopped out with a 10 pip loss. You went short again, you made 10, 20, 30, 40, 50, 60 pips as it fell. And most people prefer to use our range charts, which this is a 6 pips per bar range chart, which really clearly, accurately shows you how to trade it. You know, when you go short, let's say right here when it breaks the trend line, you get out with a loss. You go short again right here at 79, and the trailing stop kept you at all the way in until 10. So you made 69 pips minus your spread on that last trade, and you lost less than 10 pips on the losing trade. So again, new traders always ask me, what's the winning percentage of your systems? And I always respond, that's a stupid question, only asked by new traders that have never traded before or have never made money trading before. They certainly don't trade for a living. Professional traders don't give a damn whether any individual trade is going to make money or not. They care if over a series of trades, 10, 15, 50, 100 trades, that their wins are bigger on the series than their losses. Some days you're going to be, taking a trade where you lose, the next trade wins. Some days you're going to take a loss, and then the third trade wins. You lose 6 pips and you lose 12 pips, and then you make 40 pips. Guess what? You're left with pips, even though you're only right 1 out of 3 times. So, get the nonsense about what winning percentage is out of your mind, and you will trade a lot better. Now, that being said, there are some days that are very easy, and you can take 10, 15 trades and be 80, 90%, and even 100% accurate. It happens to all of us once or twice a week. However, I should say it happens as you become a professional trader. Most weeks you'll have 1 or 2 days like that. New traders, seldom do until they learn all that they need to learn. But using the currency meter, you can see found incredible big moves, and you're going to have losses occasionally, but those losses are tiny, and you have to have the discipline and patience to wait for the good trades, but also to exit immediately. So in other words, have a lot of patience in order to get into trades, but have very little patience once you're in a trade. If it's going against you, get the hell out immediately. But if it is going your way, then do have patience. Have patience when it's going your way, and have no patience when it's going against you.